Selamat malam Bapak, Ibu, dan seluruh peserta webinar. Kita akan memulai webinar pada malam hari ini pada pukul 7:05. Sekali lagi, kita akan memulai webinar pada malam hari ini pada pukul 7:05. Terima kasih. Selamat malam Bapak, Ibu, dan seluruh peserta webinar. Selamat datang pada webinar yang diselenggarakan oleh Phillip Futures, Phillip Capital bersama dengan CME Futures yang berjudul How to Hedge Physical Soft Commodities with CME Futures. Perkenalkan, nama saya Krisela Erika dan pada malam hari ini saya akan menjadi host pada webinar malam hari ini. Sebelum kita memulai webinar pada malam hari ini, izinkan saya menginformasikan outline webinar malam ini. Webinar pada malam hari ini akan dimulai dengan sesi pembukaan, dilanjutkan dengan pengenalan Phillip Capital, dilanjutkan dengan pengenalan pembicara kita pada malam hari ini, yaitu adalah Mr. David Ng, pemaparan materi dari pembicara, dilanjutkan dengan sesi tanya-jawab, dan diakhiri dengan sesi penutup. Nah, seperti Bapak dan Ibu bisa lihat pada layar bahwa setelah pemaparan materi, kita akan memiliki sesi tanya-jawab atau Q&A session. Nah, jadi jika Bapak dan Ibu memiliki pertanyaan seputar materi pada malam hari ini, atau seputar dengan Phillip Capital, bisa langsung mencantumkan pertanyaan pada kolom live chat yang terdapat di sebelah kanan layar Bapak atau Ibu. Nah, selain itu, Bapak dan Ibu juga bisa mencantumkan pertanyaan melalui WhatsApp kami di 0855 9906 526 atau membalas pesan yang telah kami kirimkan melalui WhatsApp. Baik, selanjutnya saya akan memperkenalkan mengenai Phillip Capital. Phillip Capital sendiri merupakan gabungan perusahaan layanan finansial yang didirikan pada tahun 1975. Kini, Phillip Capital telah tersebar di 15 negara dengan headquarter-nya yang berada di Singapura. 15 negara lainnya adalah Indonesia, Kambodia, Malaysia, Thailand, Vietnam, China, Hong Kong, Jepang, Australia, India, Turki, United Arab Emirates, UK, France, dan USA. Beberapa perusahaan finansial yang menjadi member dari Phillip Capital, yaitu adalah Phillip Futures, yang terspesialisasi pada produk perdagangan berjangka atau futures trading, Phillip Sekuritas Indonesia, dan Phillip Asset Management. Baik, selanjutnya saya akan memperkenalkan singkat mengenai pembicara kita pada malam hari ini, yaitu adalah Mr. David Ng. David Ng sendiri merupakan seorang full-time proprietary trader di Iceberg X SDN BHD, sebuah perusahaan trading yang berbasis di Kuala Lumpur. Ia memiliki pengalaman pada penelitian ekstensif di pasar komoditas dan juga indeks. Sebelumnya, David Ng merupakan spesialis derivatif di Phillip Futures SDN BHD yang memberikan komentar reguler mengenai pasar kepada media lokal, seperti The Star, Business Times, dan juga The Edge. Baik, ladies and gentlemen, without further ado, Mr. David Ng. Hello.
Hi, Sheila. Can you I just want to do a sound check? Can you hear me and can you see my slide?
Yes, perfectly.
Yeah. Okay, that's good. Thank you for the kind introduction. Just before I start, just like to thank Phillip Futures and as well as CME Group for inviting me to speak on today's topic on how to use or rather how to hedge your physical commodities using the futures contract.
We're very glad to have you here.
Yeah. Thank you. Yeah, just before I start, a very usual risk disclaimer. I think anything I present here is purely for educational purpose. And I think, if you dabble in futures market, I think Phillip Futures is a very good broker. They are more than sufficient enough to help you and assist you in your futures trading. So do consult with your licensed advisor. And if you can hear my voice now, I think probably you notice something different because I'm actually still recovering from a flu and cough. So I do apologize in advance if on and off I'll be taking sip of water because I had a bit of dry throat. So I do apologize for that. So other than that, I think I'm good to go. So feel free if you have any questions, as what Shah has mentioned earlier, please post it in the question box there. Then we can answer it towards the end of the webinar. So this is what I'm going to cover today. I'll be talking mainly on CME grains. So if you are familiar with grains market, you got grains are like your corn, your soybean, your wheat, and so many others. So obviously I only cover these three major grains market, because if to cover every single grain market, it will definitely take more than the webinar. So my focus in this webinar is going to touch on these three, and that will be a topic of discussion for tonight's webinar. Now, before this, I was an analyst, before I was being a full-time trader. So being an analyst, we look at a lot of data, a lot of facts. If you are trading the CME market, one thing good is that, you have a lot of data. And, the exchange itself is very transparent with the data. You get it very timely, and to a certain extent, it's also very accurate. So if you are trading the market, you won't be afraid of getting bad data. You won't be misinformed. So as long as you make sure you know what data are you reading it correctly, then that pretty much cover the fundamental aspect of trading the grains market. So CME provides a very good benchmark in terms of data, especially for the grains market. So I think in the first part, what I'm going to do is going to cover a little bit on the fundamental aspect of trading the grains market. Because if you are someone that is in the market, whether you are a trader or whether you are a physical producer, you could be producing soybean, for matter of fact. Sometimes it's good to have a perspective on where the market is heading. If you are looking at the market, you're watching the market recently, it's a crazy market. You have seen prices rally to or levels that we've not seen before. Soybean is almost touching $16. Corn is almost touching $10. Wheat is the craziest. Wheat from as low as $6 to a bushel. Now we are looking at about 12, highest in history. So there's a lot of news flow coming into the commodities market the last 2 weeks. So I think it's important for us, if you are watching the market, to at least understand some of the key factors that actually affect prices. I think towards the second part of the webinar, I'll be guiding more on how to use the futures contract to hedge your price risk. Now, this is important. Futures market itself is built in a sense that, it helps you to transfer some of your price risk. If you are a producer or whether you are a consumer of the product, you need that product. Ultimately, you still face price risk. And this is something that, futures market helps you in a way that it helps you to elevate or you transfer the price risk to other people, and that's the function you exchange. So I'm just going to touch the second part, possibly on going deeper on how to use futures market as a way to hedge your price risk. So now I think I'm not going to touch too much on other commodities. If you are, this year is really 2022. Obviously we are 2 years into COVID, and 2022 everyone is talking about recovery. So obviously this is a year of commodities. Everyone was, if you are on equities market, everyone was saying, well, equities market is definitely a market to be in. But this year is going to be a different year. This year, 2022 so far is a commodity play. Look at crude oil, energy price, WTI. We are above 100. Obviously, just last 2 days, we are seeing prices start to retrace a bit. But nevertheless, energy is definitely the commodity that's been rising tremendously. Besides energy, we also see a lot of grains like soybean, coffee, even to a certain extent soybean oil, which is related to palm, which is an important commodity in Indonesia, and many others grains market, even sugar as well. So if you're going to your cup of coffee, you're going to have your next cup of coffee, be prepared to pay higher price going into further months, because coffee prices has been skyrocketing, including sugar. So these two are the main ingredient to make your cup of coffee. So going forward, we're definitely going to see higher prices for a simple cup of coffee. So this year is definitely going to be a theme of commodities, and this is what drives inflation, and it's going to be a key concern. Whether you are in the market or not, it's going to be something that we will be hearing for quite a while. Now, if you are trading the grains, obviously you'll be familiar with corn, soybean, and wheat. I just want to share with you the calendar, because I just want to let you know which are the months that is corresponding to planting months and which are the months that's corresponding to harvesting. So for example, if you are trading the US soybean or US corn, normally April to June is the planting season. So we are actually going to go into planting season very soon. So if you are watching the market, end of March will be what we call the intention report or planting report. So normally market will look at that quite seriously. For any sign, if let's say this year they plant more corn, so you expect corn production to go up. So once you expect corn production to go up, normally price will come down. So same goes, if this year a lot of farmers decided to go for soybean, then normally you see soybean prices to come down. So the interrelationship between corn and soybean is such a way that farmers have limited land. They only have to choose corn or soybean. They can't plant both because you only have a limited land space. So one way to make them decide which particular commodity to plant is basically the price. So which is more attractive, corn or soybean? So later on, we'll probably touch a little bit on that. But just do take note, April to June is the planting season. Then when it comes to end of the year or third quarter is where your harvesting will start. So normally that time price will be very volatile. So weather is important. If weather is bad during that time, normally you see prices tend to be quite bad as well. So this is something that for us to take note. Now, I put also Brazil and Argentina is because US is the largest soybean producer and corn. Brazil and Argentina, they are also soybean producers. In fact, if you look at 20 years back, those days Brazil and Argentina, they are not big. I would say Brazil at the time, probably they are top 5 soybean producer. Right now, if you look at it, Brazil is the biggest, is the largest in the world. So they've overtaken US. So therefore, if you want to understand the soybean supplies, you have to look at Brazil. Any weather event in Brazil will definitely have impact on prices. So this is something that for us to take note as well. Now, if you look at Brazil, it's slightly different from in terms of their harvesting and planting. Brazil starts harvesting now, and they will start planting towards the end of the year because one is northern hemisphere, one is southern hemisphere. So the weather is totally opposite. So there's something for us to take note. So in a way, you have US and Brazil supplying soybean all year round. You don't have to worry that, if US cannot supply you, you can always look at Brazil and Argentina. So that's how we look at the dynamics of the market. So these are some of the factors that affect the grains market. I'm not going to go too deep in detail. I'm just highlighting you. Now, obviously, when you look at what determines price for commodities, is always demand and supply. If demand is good, normally you see prices to be good. If supply is very tight, like what we are seeing now, certain commodities, the supply is very tight. Normally you see prices tend to be supportive. So these are some of the key things that we need to look at whenever we look at grains market. Seasonality is talking about more of prices in terms of which period of the year normally prices are strong. So like if you go towards like soybean, if you go towards the year end, prices tend to be stronger because holiday season is coming, demand is going to be strong, supply seems to be tight because there's not many farmers going into the farm to harvest the soybean. So normally towards the year end supply, the prices tend to be strong. So if you are someone trading the soybean or corn market, you need to look at report. One or key report is USDA. They publish a reports on monthly basis, and if you are someone that's trading the market, do watch out on this space because some traders, they like to, if you like big movement in price, they trade on the report day, whenever the report day for USDA. If they don't like it, they avoid those days. So it depends on individual. But it's important because this USDA report on monthly basis, it will affect the price. So close substitutes prices, they also affect. These are some factors. Crude oil. Now, crude oil is important. Why it affect grain prices? Because if you look at a term called biofuel, we use grains for using biodiesel and whatnot. So corn is for ethanol, soybean is for biodiesel. So all these are actually price of substitute. Whenever high energy price like WTI, as what we're seeing, going into 120, 130 US dollar, that's expensive. So a lot of people will actually blend some of the crude oil with vegetable oil, like soybean or even corn. So that will actually increase demand, and that will push prices of these commodities even higher. So I think crude oil is another dynamics, another factor that can actually influence grains prices as well. So geopolitics, what we are witnessing in Ukraine and Russia is having an impact on the wheat market. So that's what is important. So it's going to have an impact. Weather is the last one. Is something. If you are watching the market, weather is something that we find it very difficult. First of all, it's unpredictable. Even the best model, you can predict the best weather, like the Australian model, they claim to be the best. Even they get it wrong sometimes because as what people say, they claim climate change, weather extremities is getting worse. Just like I'm based in Malaysia, you just look at in recent months, we have seen a lot of floods going here and there. So it actually literally caused the harvest of palm oil to be affected. So these are some of the weather elements that actually can affect your agricultural prices. Now, so one of the key factors that can tell you where prices will go is to look at stock and usage ratio. So basically, this tells you is you have low stocks and demand is good, your stock to usage ratio is going to be low. Whenever you have low stock usage ratio, that tells you the commodity is very tight. There's not much supply. There's no more stock. So the best way is for you to harvest more. And prices, in that sense, you can't go even higher. It has to go even higher because there's not much supply in the market. So if you see corn and soybean right now, the US corn and soybean is actually very low in terms of their supply and stock level. And demand is actually quite good. So that tells you why prices has actually been going higher and higher. Now, I'm not going to touch too much on wheat. You have probably seen the news. Russia and Ukraine itself, I think they contribute close to 30% of the total wheat export market. So if these two countries are going to war, definitely, you can roughly accommodate 30% of the global wheat supply is going to be decimated, gone. So such a big amount of supply gone in the market, it will tells you a lot that wheat generally is going to be a tight situation. So that's one of the key thing. Whenever we have geopolitics, it's going to affect commodity. So you look at oil, you look at grains, they're all actually as an effect of the geopolitical tension that we're seeing. So Ukraine, for example, not only they are a big contributor to wheat, they are also in sunflower oil, which is #1. So that's why you see palm oil prices, which is rallying because vegetable oil is actually very tight right now. So I think this is some of the key things that we need to look at. If you are looking into the grains market, so as long as the conflict doesn't resolve in the near term, likely you still see Russia-Ukraine conflict to remain very relevant to prices. So prices can't come down too much because as long as there's conflict still going on, supply is going to be affected. Now the thing I want to point this out is because Russia, despite they are also big in wheat and big in the grains market, they are also very large producer in fertilizer. And if you are in the plantation industry, you probably have noticed that fertilizer cost has actually increased tremendously. And this is going to be a problem because the world needs fertilizer. If you don't have fertilizer, you get affected. Your yields are going to get affected. So this tells you that the supply chain, or in other words, as simple as that, be prepared to pay higher price. So inflation is definitely going to be a concern going forward because commodity is not going to be cheap. Fertilizer cost is increasing, therefore your cost of production is going to increase. So in the sense that inflation is going to be a big problem going forward. So now, if you look at soybean prices, you can clearly see that soybean has also been rallying very strongly from $12 right now to touching about $16 per bushel. Reason is because we have a tight supply. You look at Brazil and Argentina, despite now is their time for them to harvest, they are not harvesting that well. Reason being because you can clearly see, both these countries, their supply is affected by weather. I think last 2 or 3 weeks, we see a bit of La Nina situation in Brazil and Argentina, a bit dry season. So their production may not be that good. So therefore, I think that's why prices tend to be a bit more strong in this couple of weeks. So again, I say weather will have a big impact in terms of your agriculture prices. Now, that's on supply. If you go into demand side, you can clearly see US soybean and corn, despite low supply, the demand is strong. And this is important because if supply is tight, demand is strong, prices can only go one way, which is up. And that's important. And if you look at it, the major country that demand US soybean and corn is actually China. So I think as long as China is progressing very well, their economy is growing, the US soybean and corn, there'll definitely be more demand. So that's something for us to pay more close attention to as well. Now, this is the chart where I wanted to show you. So if you look at early 1980s, US was the #1 producer of soybean in the world. That was overtaken in the early 20s, and now Argentina, Brazil, we call it the South American supplies actually overtake US by a big gap. So in years to come, we still rely on US soybean, but we will rely more on the South American beans because they are going to be the largest producer in the world. So that's something that we really need to be also concerned of if you're looking at the soybean market. So I just show you, why did I mention crude oil and soybean? You look at their prices, they actually move in tandem. You can see every time when you have high crude oil price, normally soybean price will also be strong, and vice versa. Same goes for if you compare crude oil and corn prices. You have high crude oil environment, normally corn will be used for ethanol because, like I said, because biodiesel, you always shift the energy demand from food. And when you have high energy, high price environment, normally it's beneficial for you to shift some demand away from food over to energy complex. That's why whenever you have high crude oil price environment, that's what you're seeing right now in the market. Normally grain prices will also tend to be strong. So I think that's a very good indication for you. If you're trading the market, these are the potential factors that can actually affect your grain prices. Now, this is a chart to show you basically comparing the soybean to corn price ratio. Like I said, farmers in US, they have limited land. They don't have big land. They can plant both corn and soybean. They have to make a choice. Every planting season before they plant, they have to make a choice whether they'll plant corn or soybean. So a way for them to determine whether this year they'll plant more corn or soybean is to look what we call a soybean to corn ratio. So this ratio, basically, they take the price of these two commodities and put it as a ratio. Whenever the ratio falls below 2.4, which is the long-term average, normally, as what you're seeing now, right now, the ratio is doing about 2.2. That means corn prices is actually more attractive, and therefore farmers will actually go and plant more corn. If the ratio goes above 2.4, that means soybean is more attractive. They'll plant more soybean. So right now we are seeing corn is actually more favorable. So a lot of farmers are expecting this year they'll plant more corn. So if you are trading the corn market, do watch out end of the year. Probably you can see a bit of correction in the corn market because supply is going to come in. Assuming weather is normal, the corn supply is going to come in towards the year end because a lot of farmers now are going into the corn market. They're going to plant a bit more corn rather than soybean. Now, if you are trading a grain market, it's also important for us to look at what we call, we call it a net futures position. So if you are new to futures market, futures market, whenever you hold a position overnight, we call it an open interest position. And if you don't close it, you leave it open, it's going to be counted as an open interest. So in US, we always have very good data in the sense, we get to know out of all these open position that's in the market, are they net long or net short? So if all the people in the market is holding long position, net long, that tells you that a lot of these people, whether they are professional trader, they are institutional, or they are probably player in the industry, could be the farmers, could be the processor, they are expecting the market's going to go up. That's why they're holding long position. So if you see right now the dark line here, it's basically, every week they come out this data. So last week's data, the managed money position is actually net positive, and in fact it's going higher. So that tells you that the player in the market is willing to hold more long positions in the market, and they are positive that prices can go even higher. Now, why this is important? if let's say next week, if you see this data, it starts coming down, some of these people who are holding long positions starts to get out, or probably they turn negative. Usually it will be the first sign we can see in a net position. So it's important, if you are trading the space, you want to understand the dynamics of the market. What is the people thinking? You can look at the net position, which is reported on a weekly basis. So I say this is an important tool for you to gauge where the market is likely to go. Okay, so I think this summarizes the US DA report. Weekly we have the crop progress, we have sales figures. Monthly we have USDA. Quarterly we have the grain stocks. Even we have the acreage report. Anyway, if you look at it, there's tons of report in the market. So you'll be asking me, so what's actually really important? To be frank, I think every single one is important. Obviously, I think Phillip Futures, perhaps maybe they do also have commentaries. You can even look at their commentaries for some of the summaries of this report. But if you are trading the market, the grains market, it's important for you to understand each of this report, because it's going to have an impact ultimately to your price. Okay, so this is basically to show you again, using whenever you have high energy prices like WTI going into 100, normally grain prices will be supported, because you look at corn is used for ethanol, soybean is used for biodiesel. So when you have high price environment, it's beneficial for producer to produce biodiesel. But when you have low price environment, that's a different story. Normally they won't produce biodiesel, because if energy price is so cheap, there's no incentive for them to produce. So that's something for us to take note. Okay, now just to show you a news announcement. This is just recently in US. So if you are trading the palm oil, or even you are in the soybean oil market, just one decision by the US president to just say that, oh, okay, probably we may not put a mandate on producing biofuel. Just one news like this, you can see a reaction probably on the soybean oil market, which is a mainly feedstock for biofuel. It will drop, it straight away plunge by 3%. So it's important for us to understand the impact of government policy. So every time if you are just looking at data only and you're not sensitive to government action, that's another area that we also need to pay close attention to as well. Obviously, we cannot predict what the US government is going to do, but it's important for us to understand what's the reaction is going to be every time when this kind of news comes out. Okay. So I'm not going to touch too deep on this backwardation and contango. These are all very technical terms. So what I'm trying to highlight is that if you look at the futures market for corn and soybean and wheat, if you take each of the price up to a year, you see those prices starts coming down lower and lower and lower, which tells you that the actual market right now is very tight. But going into the future, the market situation will reverse. In fact, supply is going to come in towards the second half of this year. So that's what the market is telling you right now. So we cannot be overly too bullish, and we also cannot be overly too bearish. So in fact, be prepared that second half of this year we should see prices start to normalize, assuming supply is normal. Again, things can change, weather can cause haywire. So all these parameters can also be reconfigured. Okay, so I'm moving on to the second part of the webinar. So we understand how fundamental plays a role, how different factors affect prices. Now, importantly, in any market, the futures market is relevant because it provides you as a tool for you to hedge your risk. So if you are producer, you are in the soybean market or you are in the corn market, you are exposed to risk, price risk every day, day in, day out. So futures market provides you a very good avenue for you to hedge this risk, or rather transfer this risk to somebody that's willing to take that risk. So like I say, even I'm a trader, I'm a full-time trader. I trade based on speculative positions. I always tell myself, even traders themselves, they are not involved in a physical commodity. They are also still managing their risk. That's the job of a trader. They have to manage their position. They have to manage their position entry. So ultimately, every participant in the market use the futures market as a way to hedge or to manage their risk. So hedging is an important tool, and futures is a very good instrument for you to be hedging your price risk. So yeah, I'm just going to go very briefly on what is futures about. So if you are someone new to first time hearing the word futures, or you are new to the futures market, I hope this can provide you some insights. So feel free, you want to find out more, you can always approach Phillip Futures. They can be more than enough to they are more than willing to help you in this regard. So I think coming back to this session, I think I'm probably going to introduce to you some of the basic futures terminology, and obviously on some of the key principles what you need to know whenever you do hedging using futures market. Okay, so commodities futures, we have a few types. So I just mentioned today's topic is about grains. So grains, we have corn, wheat, soybean, which I covered earlier in the slides. Soy meal, soybean oil, which is a byproduct of soybean. I know we have many others as well, which is not going to be covered here. We have precious metal, so like gold, silver, platinum, base metal, copper, aluminum, and we probably heard over the news, the infamous metal space, the nickel market. So these are all base metal. Energy, obviously, crude oil, heating oil, gasoline, and natural gas. So there's many others. These are some of the key commodities, and all of these commodities as listed here, there is a futures market. So that allows you to hedge your risk quite effectively and quite efficiently as well. So definition of a futures contract in plain and simple terms is just a contract between two parties. So whether you are a buyer of a contract or you're a seller of a contract, you have to fulfill the obligation. So the reason we use futures market is because first of all, it's always through a license exchange. CME exchange, especially the grains market, the seaboard market, is one of the largest in the world. These are the three key products I mentioned: corn, soybean, and wheat. You talk about soybean every day. The average daily volume is in surpass of 100,000 contracts. So you don't have issues about liquidity. Liquidity is never an issue when it comes to exchange like this. So I think one of the key benefits of going to a futures market is that you're going through an exchange, which is a very regulated industry. And obviously you have to go through a broker as well, which again also regulated by a regulated body. So when you perform a futures contract, it's always between two parties. And in that contract, it always tells you the quantity and the quality of the commodity. And it's always fixed. There's no say that two contract is different. There's no such thing. Every contract is the same. So I think that gives you a lot of assurance. So if you are a producer or if you are a buyer of a commodity, you are rest assured the quantity and the quality is always fixed. You don't have to worry about, there's a slight change in quality, it's going to affect me. No, you don't have to worry about that. Because the futures market, futures contract itself is standardized in such a way. Okay. So in that sense, a standardized contract that locks price in the future is in a future delivery. So whenever you're dealing with a futures market, it's always about talking about future time. You never talk about spot time. So say for example, if I want to go into the corn market, I'm looking at May contract. So that means this May contract, the expiry is in May. I have probably about 2 months to be exact. So it's always for a future delivery. If you want to hedge, the good thing about futures market is that it's also good in a sense that if I have an exposure that is 1 year later, you can always go to the futures market and hedge that, because there's always a contract that that allows you to hedge throughout more than a year, say for example. So I think that in a sense, futures market gives you that kind of breadth. You can have many different months that cater to your hedging necessity in such a way. Okay. So now some basic futures terminology. Now this may get a bit complex, but do bear with me. Whenever it refers to futures market itself is a market by its own. So if you compare what we call cash market, it's usually referred to physical market. Now, just to draw an analogy, if you trade on a soybean market, let's say you are the US soybean producer, we have they have two different price. One price will be the physical price. This is what they transact in a physical market, or what we call a spot market. Now, the CME futures market, there's also a market for that. And that's what we call the futures price. The cash and spot price against the futures price, they could be different in certain time. Although, theoretically, there shouldn't be any different because it's the same product. There shouldn't be any difference in terms of the market. This way, we always say, if they're different, there's always opportunity for you to arbitrage. So I'm not going to go too deep on what arbitrage is, but bear this in mind. In theoretical concept, the cash and spot market should be the same as a physical market. But in reality, it doesn't always stay the same. Okay, so if you hear the word phrase like, oh, this is a spot market or cash market, it tells you this is a physical market. When it comes to futures market, it's referring to the futures market on the exchange, whether it's on CME or CBOT or any other exchanges. So that's the futures market. Now, basis is something that we need to be careful of and we need to be aware if you are doing hedging. Basis basically tells you, like I mentioned earlier, the spot market or physical market and the futures market is the prices can be different. And if they differ, there's always what we call the difference is called a basis. Now, like I said, correct, in theory, it should be the same. But in reality, there's a lot of factors that cause the spot prices and the futures prices to be different. It could be, the sudden surge of demand or sudden surge of supply. It can change the physical price to be very different than the futures price. So this is something for us to take note, because if you are hedging, if you are doing hedging, you need to be aware that the price basis difference is a risk to you naturally. So important for us to track every day the physical price against the futures price and make sure that the gap doesn't become too big. If it gets too big, then in other words, your hedging cost is going to be higher. And that's something for us to take note if you are intending to do hedging in the future. Okay, market price, this is basically, whatever price you see on your platform or Phillip futures platform, that's what we call market price. It's basically a bid price by the buyer and the seller. Long basically means that you are buying a contract. Short is basically meaning you are selling a contract. So the good thing about futures market is that, at some markets or some exchange, they don't allow you to short sell a position, meaning that you cannot sell a position that you don't have, in other words. So, in futures market is highly flexible in the sense that if you have a view that the price is going to go down in future, you can always take a short position first. So in a way, you are selling a contract first. So I think that's one of the key benefits of going into the futures market. It actually allows you to sell a contract first. And another key term is offset. Offset meaning is that if you are buying a position in a futures market, to offset this position, the long position that you have, is by selling back into the market to close your position. And vice versa, if you sell a position first, to offset it, you have to buy back a contract in the open market to close that position. So that's what we call offset. Okay, delivery. Now, futures market, certain markets futures contract are deliverable and certain markets are not. So commodities in general most of the contracts are deliverable, which means that every contract that you take, whether it's a long or short position, you are obligated to perform the delivery. So if you are holding a long position, that means you are a buyer. And one contract on soybean is 5,000 bushel. 5,000 bushel, if you turn it into metric tons, about 127 metric tons, which is a lot. So at the end of the month, if you forgot to close your position, you have to be prepared to get this delivery of 127 metric tons. If you are a short position, that means you are a seller. So that means you have to sell 127 metric tons by the end of the contract to the buyer. So that's what we mean by deliverable. Spread basically is price relationship between futures contract. It can be different months. So let's say, for example, corn. You look at May and July corn, there's a price difference. So that's what we call spread. Spread can also be can be also inter-commodity. You can look at corn price and soybean price. There's a spread. So spread can be a lot of definition, but it's all talking about price differences between two different same commodity or different commodity. Hedging is something I mentioned earlier. It's all about reducing your risk. Open interest is another concept which I mentioned earlier. So basically, it tells you all the contracts that's actually not been offset or haven't been closed on the open market. So just now I mentioned about a managed money position, which is reported every weekly. That's basically taking all the open interest and taking the long and short position and to net it off. So if overall the market is net long, that tells you the market is actually quite bullish. If open interest is net short, that tells you the market is actually quite bearish. So that's the definition of open interest. Okay, now I think trading futures market requires you a margin. So if you are trading this, whether it's corn or soybean, there's a margin that you need to put up. So say for example, the margin varies accordingly. If you want to get the latest margin, you can always consult Phillip Futures representative. They're more than happy to tell you what's the latest margin. If I'm not mistaken, if you want to trade one lot of corn, it's about $2,400 US. Soybean is about in a circle of 4,002 to 4,004 US dollar per contract. So that's the margin that you put up. It's in a way a guarantee bond between the buyer and the seller. So in a way, is to guarantee the safety for both the respective buyer and the seller by putting up a margin. Okay, now I'm not going to go repeating the concept of hedging again, but ultimately what hedging means is that you are just transferring your risk, the price risk to somebody else, to the market, by establishing a futures contract. So that's as simple as that. Now, why risk management is important? I think key thing is, first thing, if you are a producer, you always want to make sure that you are not exposed to price risk. If you are a producer, you're exposed to too much price risk, your cost or even your P&L will get affected very badly. So one way is to always manage your price risk through the futures market. So like I mentioned earlier, these contracts are durable. You don't have to afraid, because ultimately you have the intention to deliver that particular commodity. So in a way that you have transfer some of the risk that you are not willing to bear to somebody else. Then obviously there's a cost to pay for this hedging. It's never a free thing. So that's where you need to balance whether the cost of hedging is sufficient enough for you to protect this risk. It's like buying an insurance. You want to be protected against certain circumstances. So you have to be prepared to pay the premium. So that's in a way, hedging is basically buying an insurance. So there's certain risks that you can always transfer to another party. It's like buying an insurance. You can reduce using internal controls. You can totally avoid the risk. Basically, you don't involve in the market at all. That's the simplest risk measure. You can share that risk, although it's not that practical. No one's willing to share risks in a business or in a particular aspect. Okay, now I again re-emphasize on this basis and its risk, because I just want to put up this point. Every time when you want to hedge your commodity, you need to understand what is basis, because if you don't get this concept, it can be a cost to your hedging. So first of all, hedging is never cost-free. It does comes with a cost, and basis is one of the costs. So what is basis again? Basis is basically telling you, the cash or physical price is different from the futures price, although it's the same commodity. Why is that so? There's a lot of factors that explains why it can happen. Basically, it's down to fundamentals. But importantly, is how big is the gap. If the gap is very big, sometimes it's not worthwhile for you to do hedging. But if the basis is small and you can take it, that's one of the good way for you to also be using a futures market as a way to hedge your risk. So importantly, to always measure what's your basis risk. If you're comfortable with the basis risk, you don't mind to have a gap, minor gap in your hedging program, just go do it, because basis ultimately is something that's going to be, realistically speaking, it's going to be in the market. You can't totally take away basis risk. That's in a way contribute to the cost of your hedging. Okay, I'm not going to go too much on the concept of hedging, but it's basically down to whether are you a consumer of the particular commodity or are you a producer, because these two aspects of players will have different type of profile when it comes to hedging. Okay, so using CME futures contract, these are the way for you to hedge your instruments using the futures contract. Now, who needs to hedge? Now, this is interesting. Like I mentioned, first of all, you need to identify whether are you a consumer of the commodity or are you a producer. Because both of position you're taking in the market is very different. If you're a producer, that means you are supplying. So naturally, you will be tending to buying position in the market. If you're a producer and you are consumer, you tend to buy positions or tend to buy commodities in the open market. So in a way, for you to hedge, you'll be selling positions in the futures market. So it's always important for you to distinguish whether are you a consumer or a producer hedge. So like, for example, farmers and livestock producers, generally they need to hedge because any change in, let's say, feedstock, their cost of production is going to increase. Merchandisers and elevators are also their middlemen. They also need to hedge their produce because if they don't hedge, they are also exposed to price risk. Food processors are mainly, they are the key people that always need to measure against their price risk. Big food processors like Mars, your chocolate bars, they really need to protect their raw material price risk because their raw material costs can fluctuate very rapidly on weekly basis, in fact on daily basis. So they really need to hedge their risk on a daily basis, in fact. Okay, exporters, importers, naturally they are also exposed. So basically these are all the list of people that will be beneficial if they go into the hedging the futures market for their particular commodities. Okay, so these are some of the key steps for you to design a hedge program. So first of all, you need to make sure that whether are you a consumer or a producer hedge. So example, producer naturally long because you need to sell futures, or we call it a short hedge. So in this example I'm using a wheat maker. So the wheat producer will be the one that's farming the wheat, planting the wheat. So technically you need to sell futures as a way to protect your harvest. Bread maker is someone that is going to buy the wheat from the farmer. So naturally he's going to be natural short. So in a way he needs to go to a futures market to buy the futures contract in a way to protect his feedstock costs. Because if you're a bread maker, if your wheat price suddenly jump, like what we've seen in the last couple of weeks, you will probably suffer if you don't hedge properly. Because consumers, if you pass the cost to consumer may end up, I won't be eating bread anymore. Then you probably be caught red-handed. So I think it's important for whether you're a producer or you are the consumer, you need to always make sure you protect your risk. So some key points to take note. First of all, you need to choose your contract with a similar underlying. It cannot be totally the same. The best is the same. If you are a corn producer, the specification of corn is stated on a CME website for each corn contract. Like for wheat, you have the soft rate and hard rate. So this type of wheats, you need to be aligned with what you're producing. So obviously, you try to find the commodity that is very similar to what you're producing. Don't go astray too far. Secondly, you have to determine how many lots to hedge. So, like example for corn and soybean, each contract on CME is 5,000 bushel. So assuming if let's say you produce 1 million bushel per month, you divide it by 5,000 per contract, you're talking about 200 lots. You need to hedge every single time or every month. So that's how you determine what we call a hedge ratio. How much you produce divided by the size of per contract on the exchange. Now, the third thing is the length of a hedge. Whether is it for a few months, for 6 months, or 1 year. Normally, you don't want to hedge more than 1 year. The reason being is because if you hedge more than 1 year, you never know commodity what will happen in years time. The prices you see on futures market a year out normally will not reflect much fundamental. If, for example, 2 weeks down the road, a weather come into play, the prices will get screwed up. So normally we will recommend that, if you want to do a hedging program, look at 3 to 6 months. Anything more than 6 months, you be prepared to face a lot of high volatility risk in terms of price fluctuation. Definitely more than a year out is something that you have to be very careful if you want to do a longer term hedge program, because that will get a bit more complicated. Fourth thing, always take care of your margin. Make sure you have sufficient margin. And later I'll show you some examples of hedging, how to use some hedging examples. Do take note, those examples does not include commission. So again, I think all this you can definitely have a chat with Phillip Futures representative. They'll be more than happy to tell you more. And last but not least, you must manage your basis risk, as I highlighted earlier on, because basis is what tells you the difference between the cash and the futures market. Okay, so I'm just going to show you an example here. So say, for example, there's this local Indonesia soybean company. It's a soybean processor. And he likes to protect his profitable crush margin. Okay, so in this example, is he a consumer hedge or is a producer? So will he be going to a futures market to long soybeans or to short soybeans? So I'm gonna give you guys probably a minute to think about it. Whether it's going to be A or B. Feel free to type your answers in the question box. I'll be more than happy to hear some of the responses. So Sheila, if you don't mind, you can probably also tell me what are the audience response for this particular question.
I think for now we need to continue because for right now there is no response from the audience, but there might be some questions asked through WhatsApp, and we will,
okay.
and we will answer the
Okay,
question.
sure. I hope the audience are not confused. Futures market to buy soybeans. So in a way, you're longing the position. Okay.
Yes, right.
Yep. So I mean, hopefully the audience are able to get it, and I'm not confusing anyone. But I'm open to questions. So if you have any questions till now, feel free to just type in the question box. Later on I can more than happy to address those questions. So just to continue, now this is a classic example of a consumer hedge. So assuming you are someone who's going to be buying a lot of soybean, technically you need soybean. This is what we call consumer hedge. So in this example that I have, assuming you need every month you need 750,000 bushels of soybean every month, and as a manufacturer, you always be thinking what's the price in the next month or so. You can always go to the futures market and look at the price. So if you're afraid that prices, because you are buying a lot of soybean in months to come, you're afraid between now and 1 month later, the price will change. And you're always afraid that the price will go up rapidly, because if you're buying, you don't want to buy too high. You buy too high, your cost is going to be quite expensive. So one of the ways is that you can go to the futures market and you can lock in a certain price. So based on example, if you just look at May, July, and August, these are the three month prices. And if you just take this as an example of 750,000 bushel, technically you should be buying about 150 lots of soybean bushel. And technically you can split out between all the 3 months equally, because you don't be buying on a single month. If your purchases are across 6 months, then do it across 6 months. So in this example, it's across 6 months. So technically we actually spread it from May to August. And these are the price that you see in the market. And that's the price that you lock it in on the futures market. Now, there's a couple of scenarios that will happen. The first scenario is once you have bought the position on the CME market, the respective months, the price rises as expected, because ultimately the reason you went and buy this position on the futures market is to protect yourself against any rise in prices. because if you want the soybean and you don't want to pay a higher price, if the price goes up, if you are not protected using the futures market, you have to pay a higher price in the future. So if you are going to the futures market in a way that, in a sense, you are really locking your position or locking your prices via the futures market. So what I have here is that very simple. So assuming on 14 March, you have entered all these long position, and as you get closer to the expiry of each of the contract, you liquidate each of the contract. So as the market goes higher, the price goes higher, technically you're making money in your futures market. So in this example, we call it a hedge gain. So if you total up after each expiry of each contract, this is the amount that you'll be getting. Now you must understand is that using futures market for you to hedge. If you're still transacting on the physical market, you definitely be prepared to pay higher price. So hedging in a way that whatever you gain in the futures market is hopefully you can offset some of your losses in your physical market. So that's the meaning of hedging. So you're using the futures market as a way to hedge out some risk or offset some price risk if you are transacting in the physical market. So this is a way for you to use the futures market as a way to hedge. Now, scenario one is assuming that if you're a consumer of hedge, you predict prices are going to go up, you're correct. Now, what happens if you're buying soybean, you predict prices go up, that's why you hedge, but it didn't turn out prices go up. In fact, next few months the prices came down. Same scenario on 14 March. These are what you have. This is what you have entered as a position to hedge, and all this position will turn into losses because prices starts to come down after you have hedged your position. Once that happens, what we call you incur a hedge loss in the futures market. Now, in this example, whenever the purpose of this hedging is you are suffering losses in the futures market, whatever loss you suffer in the futures market will be likely offset through your physical market, because by that time you are probably buying cheaper price in the physical market. So in that way, you probably gain some you gain some money through the physical market, and that will probably offset some of your future losses. So your net position, you won't be affected as much whenever there's a big price movement. In fact, if your P&L books, you may actually look quite neutral. So that's the role of hedging. In the role of hedging is in a way for you to hedge out some of your risk, your price risk, especially when you have faced too much of huge fluctuation in prices. Now, so that's consumer hedge. Producer hedge is basically those who produce the particular commodity. Now, another example, if let's say you are a corn producer, you produce 200,000 worth of bushel per month, and you always worried that corn prices, the rally they are seeing right now will not sustain. You think prices are going to come down, so you want to lock this price risk. So one way for you to do it is, if you are a producer, normally you go to the futures market to sell your position in the futures market. So 200,000, if you divide it by 5,000 bushel per contract, you're talking about 40 lots needed. And like I said, if you are producing for the next 6 months, your rate next 6 months, price risk is going to be impacted. Then you hedge out for the next 6 months. So for corn, normally you hedge out for May, July, or even September contract. So again, same scenario, you lock on your prices at this point in time. Okay, so you sell 40 lots each on each of the month, and these are the prices that you'll be getting in the futures market. So same goes, giving you a two scenario. If the scenario prices fell and it follows to your scenario, likely in the futures market you'll be gaining money. Okay, because the reason that you are hedging a position is you are shorting a position in the futures market, and when the prices come down, you're actually making money. So whatever the hedge gain that you make in the futures market, hopefully that will offset some of the losses that you encounter in the physical market. So that's one way for you to actually try to neutralize your P&L through the futures market. Now, obviously, if things don't work well, in fact, if you predict prices likely to come down, but in fact it went higher, so your futures market that you're shorting, you'll be turned into losses, and this will be a hedge loss scenario. So again, I think whenever in a hedge loss scenario, in months to come, you probably will see higher price, which is beneficial for a physical market. So I think that's something that's benefit you in the longer run. So again, I think hedging in a sense that you won't be benefiting a position. It helps you to manage your P&L in a better way. So ultimately, whatever hedge gain or hedge loss you encounter, you probably offset some of your physical loss or gain through your hedging results. So I think hopefully by the example, give you some clearer definition, some clearer insights on how you can actually use futures market as a way to hedge your position. And the P&L mainly from hedging is not for you to to be making money out of it. It's actually more for you to control that risk, especially when you encounter a lot of price fluctuation. That's where you really need to be very careful. So there's a few things you need to take note. I think hedging is a means of risk control and price risk management. So there's no such thing as guarantee of profit or sure win scenario. That's more to speculating position. Your role here, if you are mainly producer or consumer, is to use the futures market to hedge, not for you to make into a speculative play. Because that will really be, be a totally different gameplay altogether. So hedge ratio is something that you need to be careful. So again, depends on how much you produce. You have to divide by the amount of contract you want to engage in the futures market. So that's determined by hedge ratio. And the timing of the hedging is important. Are you looking into 3 or 6 months forward? If that's the case, then you should be hedging 3 to 6 months forward. Cost of hedging, always make sure you need to know what's your margin that is required. You have to put a bit of buffer in case sometimes price move too much, eat up your margin, and that's where you need to account those margins for. And again, managing price risk is, in my examples earlier, I didn't share with you the commission. I also didn't mention on basis risk, because in reality, the futures market and the physical market, it tends to be a bit different. So I think that's where it can be an added cost to your hedging program, and that's where you need to be careful of. As long as you're comfortable with the cost, you should go ahead. But if you're not comfortable, I think that's where you need to rethink on your hedging policy or hedging program again. In conclusion, I think if you are talking about prices, you're looking into grains outlook. I think going forward, prices tend to be still strong. Reason being is because supply is actually very tight. And I just don't see how supply is going to come in a very strong way for at least the next 6 months. So prices tend to be very strong this time around, and it will continue to be there. Now, again, I think we are still in a global pandemic, although we are trying to move out of it. But if there's new variant into play, I think that's also going to be a game changer. That's another important area we need to take note. Climate change, weather is, if you have been reading the news or you're following the market, I think a lot of this price rally they are seeing right now is actually mainly due to climate change. So if you look at Brazil, Argentina, you can clearly see, I think, why their supply is so tight is because they face a weather extreme last 2 months. So I think that's another area we also need to be careful of. I'm not going to talk too much about monetary policies. These are all economic effect, but ultimately this will have an impact on prices as well. Last but not least, risk management is important. Whether you are trading, you are a trader, you also need to manage your risk. If you are a producer, you also need to manage your risk through hedging and whatnot. So I think the famous saying is that if you are not hedging, you are mainly purely speculating in the market, and that's too much of a risk to take if you are not comfortable with that risk. So with that, I'm just going to end here and hand it over to Sheila for the Q&A.
Hello, Sir David. Thank you for the very informational material that you just gave us. I'm really sorry because of the delay of live chat that I'm getting. So there's actually some people who answered your question correctly previously.
Oh, and that's good.
Yeah, that's really good. So we assume that the attendees understand the material.
I'm happy. I'm happy to hear that.
Yes. And then we will go straight to the Q&A session. Baik Bapak dan Ibu, jika Bapak dan Ibu memiliki pertanyaan seputar topik hari ini, Bapak dan Ibu bisa langsung mencantumkan pertanyaan pada kolom live chat YouTube yang ada di sebelah kanan layar Bapak atau Ibu, atau bisa juga melalui WhatsApp kami di nomor yang telah kami hubungi sebelumnya. So apparently there are some questions asked from the attendees. I will help you reading the question.
Sure.
The first one is hedging also recommended for personal trading or only corporate trading?
Okay, I think the main presentation today on hedging is purely for producer point of view or consumer point. Consumer in the sense that you are using soybean and corn as your business commodities, not as in more of a paper trading or speculative play. I think in that sense, whether you're a producer or consumer, in that sense, hedging is important. When it comes to trading, paper trading, speculative position, like I said, I'm more into that play. I'm more into speculative, and I still need to manage my risk as a trader. And that's different. It's not called hedging. It's a different concept altogether. But I think importantly is that I think hedging is very relevant for those who are in the commodities itself, in the business of a commodity, whether you're a producer or consumer in that sense.
All right, thank you. To the next question. Can hedging also be done for stocks and index futures, or only recommended for commodities future?
Yeah, that is a very good question. Thank you for the question, in fact. Now, I would say hedging the futures market, especially if you look at CME contract, for commodities is actually very good. Because like I said, you want to hedge your production or you want to buy your consumption 1 year out. Where else can you look at? Just look at CME. There's always a contract that's 1 year, 2 years out. That's very far. So it's actually very beneficial for you to be hedging commodities. Now, hedging using index futures is still possible. But again, like I said, there's a lot of interpretation that you need that's needed whenever you use hedging in the index play, because things are different. Index, you also have this basis risk, but the basis risk always means something. And when it comes to hedging index futures, again, it's a different goal altogether. Unlike commodities, it's a durable. Indices are not so straightforward because ultimately they are always cash settled contracts. So it's again a different ball game. So I'll say it can be done for stocks and indices, but it's slightly different, and it's much easier for commodities.
All right. The third question, how's the forecast for soybean in the near future, especially in this current geopolitical situation?
Yeah, I would say, I think personally, I feel that soybean is I would say still have a bit more upside to go. I think really all-time high price $18 per bushel is not to say no, we can't reach there. It's realistically possible. But what drives prices to go there is really depends on the few fundamentals I mentioned earlier. So obviously, I think this geopolitical tension we are seeing is definitely going to be one catalyst. Any other catalyst is going to be demand and supply. If now South American harvest is bad, hopefully they will pick up. If they do pick up, price will probably adjust it a bit. But importantly, US going to go into planting season. If nothing wrong during the planting season, I think likely this year we probably second half around June, July, we should see prices start to reduce towards the $12 to $13 mark. But if US soybean is also having a tough time this year, then I think we probably should see range between $14 to $17 per bushel. It's going to be the kind of range you are seeing, in that kind of scenario.
All right, to the last question. How much the percentage of the estimated failure to do hedging?
Okay, that's another very good question. Now, it all really depends. The cost of hedging, like basis risk, is one cost. Commission is one cost. And you must understand, using futures always requires you to use margin. So margin is technically like a performance, like a performance bond. You lock it up. The exchange and the broker will lock up the margin. So really, you really need to know how much margin or capital you're willing to put up to manage your hedging position. and the ratio itself. Normally, there's no 100% ratio. In reality, there's no 100% because there's always this basis that gives you a problem. So you try to be as close as possible. Probably I'll say 75 to 80% is sufficient enough. But if you have your commodities are always in and out, you are someone that always demand the particular commodities on whether it's on a daily basis or weekly basis, then obviously your ratio has to be higher. But there's a lot of factors to determine that ratio and that percentage. Again, it depends on individual and the nature of the business, on the type of the business that they're in, and the ratio will varies accordingly. But I would say as a general term, 70 to 80% is actually sufficient enough. That's 100% is theoretically or realistically impossible. Anything higher than 90% sometimes it's going to be quite a cost burden if the gap is very wide. So I think that's some of the key things that we need to be on the lookout for, especially when you look at ratio or percentage to hedge. I hope that answered the question.
Yes, okay. So there apparently one more question asked.
Sure.
Is the lot traded of futures product and physical product need to be the same when we're doing hedging?
Okay. Hopefully I can get what the question meant. When you say lots traded, you meaning the type of the products that is being traded on the futures and the physical market is the same? If that's what the question is, obviously, if let's say you are producing corn and CME corn contract tells you, okay, it's a yellow maize type of corn, and you're producing a different type of yellow corn, then it is not the same. It is similar. There is still a price difference, potentially price difference. But overall, it's still the corn market. It still gives you that kind of direct exposure, although it's a different. I would say it's not comparing. It's like apple and orange in certain ways. So I would say you will come to that kind of reality. To a certain extent, wherever the futures market, because it's always a fixed contract, fixed specification. If it doesn't meet your physical market, that's where you might not find a perfect hedge. But like I say, in reality, there's no perfect hedge. You can't hedge 100%. So that's allowance that you need to give yourself with. I mean, going back to that question, hopefully is there is still a difference between the physical and the futures market. That there is no 100% product that is the same, in whenever you do a particular hedging.
Okay, there's another question.
Sure.
Because the duration, we still have the duration.
Sure.
So it means that as long as Ukraine and Russia, as long as Ukraine and Russia war still goes on, crude palm oil will still rising?
Yeah, very good question although this topic is on CME, I know there's a lot of relation to palm oil because it's a major commodity in Indonesia. Now, when it comes to palm oil, I would say, the ongoing conflict is going to create a bit of problem, definitely for the vegetable oil market. I don't have the chart with me here, but I can clearly tell you that, the world vegetable oil is clearly in a scenario where they don't have sufficient oil to supply the world, and palm oil is the answer. But the problem is palm oil is also not sufficient. So I understand that today we have some news coming from Indonesia, especially on the export levy and some of the domestic requirements for palm oil. So I mean, if you're asking me specifically for the conflict itself, yes, it's going to have an impact because I just showed you earlier. Ukraine is one of the #1 largest producer of sunflower oil. Now you're talking about 20% or 30% of sunflower oil in the world is decimated. The supply is gone. So there's a big gap to fulfill. I don't think palm oil can fulfill that. It's not enough, and it's definitely going to support palm oil in the near term. But palm oil itself has also its own fundamentals, which is also swayed by some of the key news that is coming, especially from Indonesia, when it comes to some of the policies that they are going into when it comes to palm oil market. So I think that's my view, and that's how I see how the geopolitical conflict in relation to the palm oil market.
All right, thank you for the answer. For all the attendees who still have questions about today's material, we will have a follow-up class tomorrow. Jadi Bapak dan Ibu, jika Bapak dan Ibu masih ingin memiliki beberapa pertanyaan perihal materi pada malam hari ini atau mengenai Phillip Capital, kita akan mengadakan follow-up class besok jam 2 siang. Besok jam 2 siang akan diadakan follow-up class yang berisi ringkasan mengenai materi pada malam hari ini, yaitu mengenai teknikal dasar hedging, kemudian ada juga spesifikasi beberapa produk komoditi, dan yang terakhir adanya perhitungan profit loss. Nah, kami akan mengirimkan link pendaftaran melalui WhatsApp yang telah kami hubungi ke nomor Bapak dan Ibu. Baik, thank you Mr. David Ng for such an informative material for tonight. And terima kasih juga Bapak dan Ibu yang telah menghadiri webinar ini dari awal hingga akhir. So, again, we're saying thank you for Mr. David Ng for being a perfect speaker for tonight.
Yeah, sure. Thank you for having me.
Yes, we're also glad for having you tonight. And terima kasih Bapak dan Ibu, and see you in the next opportunity. Bye-bye.
Sure. See you. Yeah, bye.